Good morning everyone and welcome back to Morning Markets here at True Potential. It's Thursday the 2nd of November. Today we'll reflect upon last night's meeting of the Federal Reserve in the US, the potential impact upon markets, but a broader outlook for global economic strength. The meeting yesterday went as expected, no change in interest rates. Interest rates remain at 5.5%. However, a noticeable change from Chair Powell in the guidance, that forward-looking communication. That is, economic risks are now more two-sided than they were just 6 weeks ago. Because bond yields have risen so much, the Federal Reserve are more forward-looking and expect to see weaker economic growth ahead. And it's likely that we have seen the last interest rate hike in the summer. Interest rates are likely peaked where they are now. The broader outlook on the impact upon markets is that bond yields fell. That is that bond prices rose because markets have taken out the likelihood of another interest rate rise. And this had a positive effect on US equities yesterday evening. So broadly, a very good day for markets. There was also a constructive update from the US Treasury with regards to their borrowing requirement for this quarter. They're borrowing a lot, almost $750 billion. However, they're going to lean into 12-month T-bills and 2-year bonds rather than 10-year and 30-year bonds. Markets right now have more of a desire to lend for shorter maturities, and so they took the news constructively. Why does this matter globally? Well, the rest of the world is experiencing growth around zero, and some places are even in what we would call a technical recession. Places like Germany and Sweden are actually contracting. The UK, France, Italy all have growth falling towards zero, and Canada has had no growth for pretty much the last 2 quarters. But what really matters is that we're not seeing the weakness we would normally expect in the cycle for aggregate employment. We're not seeing major redundancies. And that's what's really supporting inflation, core inflation. Normally at this point in the cycle, we could expect interest rate cuts. But because of the level of employment and the strength of core inflation, policymakers are unable to even think of it, let alone act. So we all look to the US because it's an outlier. It had growth last quarter of 5% in real terms. In nominal terms, it probably had growth of between 7.5% and 8%. And that's all because of this borrowing to spend and invest Bidenomics in the IRA Act and the CHIPS Act. So a cooler economic output from the US is required in order for the Federal Reserve to be more confident that disinflation pressures are ahead. And this all starts, again, from tomorrow's jobs data for the month of October. So please do join us tomorrow where we can reflect upon job strength, but also look ahead to see if we are seeing disinflation pressures in the US. Thank you.